Hi guys, welcome back to my channel. Today we are going to be looking at financial liabilities at amortized cost. In the first series of financial instruments, we look at compound financial instrument, and we briefly said that financial instrument is any contract that results in the financial asset of an entity on one hand and a financial liability or equity instrument of another entity on the other hand. And we did say that financial liability, when you talk about financial instrument, you're basically looking at three types of financial instruments: financial asset, financial liabilities, and equity instrument. And in that first video on financial instrument, we talk about compound financial instrument, where one instrument has both the characteristics of liabilities and equity. We showed you how to separate them. If you've not watched the video, you can go to that video. Today, we are going to be looking at financial liabilities, accounting for financial liabilities at amortized cost. So I'm going to share the screen with you, and we're going to take this brief moment to look at financial liabilities at amortized cost. You know, the last time we looked at compound financial instrument, I talked about the effective interest rate. I said I was going to explain it in details. The effective interest rate is actually used for the effective interest rate method is used for the amortization of interest over the tenure of a financial asset or a financial liabilities. For financial liabilities, when we talk about the effective interest rate, it is a rate that discounts the interest or discount of an instrument, either financial asset or financial liability, over the life of or the tenure of an instrument, such that at the end of the period, you have the initial carrying value associated with that asset. So financial effective interest rate method is used when we want to allocate interest received or paid over the life of an asset. And when you discount this asset over the period of an instrument, it takes you back to the initial carrying value of that instrument. So for financial liability at amortized cost, remember that the IFRS 9 financial instrument did say that or initial recognition of financial instrument is at fair value, that is at cost. Subsequently, for financial liabilities, you should measure financial liabilities at amortized cost, unless you've explicitly stated at the beginning that you're going to measure it at fair value through profit or loss. So the part of financial liabilities always tested in exam, ACCA, universities exams, is financial liabilities at amortized cost. So this is an adapted example from the question on compound financial instruments. So let's look at what happened. Illustration 1. On 1st January 2012, Global Bank issued a debt instrument for its fair value of 1847,720. The debt instrument is due for redemption on 31st December 2014. The instrument has a principal amount of 2 million, and the instrument carries a fixed interest rate at 6% that is paid annually in arrears. The effective interest rate is 9%. How should Global Bank account for the debt instrument over a 3 years term? So here we have the fair value of the instrument, which we can call the amortized amount. Then we have the principal amount of the instrument. Then we also have two interest rates: the nominal interest rate, the par value interest rate attached to the instrument, and the effective interest rate. So here you have two values. They say, how should Global Bank account for the debt instrument over the 3-year term? This is simply what you do. Because we want to account for the instrument over the 3-year term, and we are going to use the effective interest rate to amortize the interest element, the discount that this instrument has. Look at the principal amount is 2 million, but the fair value for which the instrument has been issued for is 1,847,720. This already shows that there's a sort of discount on this instrument. So how do you go about it? When you want to account for financial liabilities using amortized cost, you simply use the effective interest rate on the amortized value. So look at the steps that I have taken in these illustrations. Step one, I bring at the beginning of year 2012, which is the first year, I bring forward the fair value of the instrument, which is 1,847,720. The next thing that I do is that I find the interest at effective interest rate. I add it to this instrument. Then I subtract the interest payable. Now, when you're accounting for a financial liability that has both nominal interest rate and effective interest rate, the interest paid or received, that is if it is financial asset, is at the nominal interest rate of the principal, not the amortized amount. But the effective interest rate is applied to the discounted value or to the amortized amount. So the principal is 2 million and the amortized amount is 1,847,720. So simply, I apply the effective interest rate of 9% of this amount. Whatever I get, I add it to this the opening value. Then I subtract the interest paid. And the addition of the opening value and the interest at effective interest rate less the interest paid that I pay every year as the issuer of this instrument gives me this for year one. This is the carrying value of the instrument at year one. The carrying value at year one becomes the opening value at year two. I also add the interest at effective interest rate. So 9% of 1,894 gives me 174,661. I also subtract the interest paid for year two. It gives me this value as 1,944,475, which is the interest, the carrying value of the liability at the end of the second year. It becomes the opening carrying value at the beginning of the third year. I add interest at effective interest rate, and then I subtract the interest payable at the nominal interest rate. By the time I add the liability brought forward to the interest at effective interest rate, and I subtract the interest paid, it takes me back to the initial 2 million, which is the carrying amount, the principal. That's what we said, that the effective interest rate is the interest rate that discounts the interest paid or received for an instrument over the tenure of the instrument, such that we come back to the original carrying amount of that asset. So the original carrying amount, which is the principal, it comes back to that amount. So I've just told you here that the interest paid column, I arrive at it by applying the principal to the par value interest rate, to the nominal value interest rate. But what I use in amortization is the effective interest rate. A few things I want to say here is that they could ask you, what is the finance cost at year one, year two, or year three? The finance cost that goes to profit or loss is the interest at effective interest rate, not the interest at nominal interest rate. And if they ask you, what is the carrying value of the liability at the end of year one? Of course, is this one. At the end of year two is this one. And at the end of year three, it is back to 2 million. So that is the first example. In this example, we have two interest rates, the nominal interest rate and the effective interest rate. And we have two amounts, the discounted value and the principal amount. The interest payable is applied on the principal, not on the discounted value. Meanwhile, the effective interest rate is applied on the discounted amount to amortize the interest over the useful life of the asset. That takes us to illustration 2. For illustration 2, what happened here is that for illustration 2, we have introduced issue cost. What do you do when there's issue cost? If They are issue cost or transaction cost. For financial asset, the issue cost is added to the price of the gross proceed to make a new value. Meanwhile, issue costs are subtracted from the issue proceeds for a financial liability. So because it's a financial liability, we're going to subtract the issue cost from the face value of the proceed. So, and then in this illustration also, we do not have the par interest rate. We do not have the nominal interest rate. We only have the effective interest rate. So let's look at what it says. It says on 1st January 2013, deferred, this is a company, issued 600,000 loan notes. Issue costs were 200. The loan notes do not carry interest rate. It means it doesn't have a nominal interest rate, but are redeemable at a premium of 152,389 on 31st December 2014. So that will mean that the lifespan of the instrument is 2 years. The effective finance cost of the debenture is 12% required. What is the finance cost in respect of the loan notes for the year ended 31st December 2014? That's at the second year. 2, what is the total finance cost in respect to the loan notes at redemption? So simply, we're going to apply the same procedure, but in this time around, what do? To get the amortized amount brought forward, first, we said that when there are issue costs, you take the issue cost away from the face value of the proceed. Now that so if there was no issue cost, I would actually bring 600 here because I didn't have an amortized value, like in the first example. But here we need to take away the issue cost first. So we take the issue cost of 600,000 of 200, and it gives me 559,800. I multiply 12%. I multiply 12% by this to get 71,976. Now, I ordinarily would have taken out interest payable at nominal interest rate, but here I do not have nominal interest rate attached to this instrument, so I just keep it at the effective interest rate. So when you add 71,796 to 559,800, what does it give to me? It gives me 671,776. Then the closing balance for year 1 becomes the opening balance for year 2. And what do I have? I apply 12% to that. I have 8613. So finally, I have 752,389. First question, what is the finance cost in respect to the loan note for the year ended 31st December 2014? Finance cost is always the interest using the effective interest rate. So for year 2 is 8617. If they had asked me for year 3, I bring this amount as the opening balance for 2015. Then I add interest at 12%. But see what happens. The instrument is 600,000 and they say it was going to be redeemed at a premium of 152,389. Look at the liability at the end of the second year is 752,389. What is it showing me? It's showing me that if I say 600 less, 752,389 less 600,000, I'm going to have 152,389. But the second question that I'll ask is, what is the total finance cost in respect to the loan note as at redemption? See what we did. If you add in finance cost year 1 to finance cost year 2, finance cost is the interest rate that goes to P or L, and it is the interest rate at effective interest rate, not the nominal interest rate. So finance cost for the total period of the instrument is going to be finance cost for year 1, which is 71,976 plus 8613 minus the issue cost, and that brings me back to 152,398. I want to say something before you go, which is that if this question did not have effective interest rate but has a par value interest rate, that it has a nominal interest rate, instead of subtracting the finance cost, instead of subtracting the issue cost from the addition of 1, 2, we also add it. In that case, we're going to have 152,598. I repeat, if we didn't have effective interest rate, but we had nominal interest rate, I just say the nominal interest rate, let's say 5%, for instance. I say 5% multiplied by 600,000, multiplied by 2 years plus the issue cost. It will give me, plus the issue cost plus premium is going to give me finance cost. So that is a difference between having given effective interest rate and being given the nominal interest rate. I hope the two examples are enough to balance your thoughts on financial liabilities at amortized cost. I catch up with you in the next video when we are going to look at financial assets at amortized cost. Don't forget to subscribe to the channel so that when there are new videos, you'll be notified. Thank you very much.